Hey everyone, today we'll be talking about a darling of the options market that you just might be familiar with. Of course, that can be no other than 0DTE options. If you've spent any time online in the past 3 years, you may have heard of these through either influencers promising that they're a fast ticket to riches, or from risk takers on Wall Street bets who credit them as the thing that destroyed their lives. Naturally, the truth is somewhere in the middle. Now, trading is objectively a difficult thing to do. If you're going to do it, it can't be a casual or side pursuit. You're going to want to legitimately invest in infrastructure, data, and in just developing a sound theoretical framework before you risk a single dollar. We're not saying that you have to build out a full quant desk, but we're not saying that either. Unfortunately, there isn't much public information on what that gap to a more professional level of trading looks like. So today, we'll be cracking the lid open to show you firsthand what a sophisticated and data-driven trading process looks like. By the end of the video, you'll be able to accurately simulate historical trades, pull real-time information on the optimal trades to make, and fully automate the process from ideation to execution. So, without further ado, let's get right into it. To start, we need to address one of the core constraints that most retail traders get wrong. When it comes to options, many traders go the route of static, fixed rule parameters. For example, buying the 30 delta option or selling puts 2% out of the money, and so on. The problem with this is that the market already gives you lots of information up front, and more often than not, it's already pricing in the trade view you have. To understand this, let's assume there's an options chain for stock ABC with an implied volatility of 100%. Your view is that in 1 week, the stock will go up by 5%. Now, here's the crucial step. We know that implied vol is 100%, so first, we can convert that into a daily expected move, a number on what the market is already pricing the stock to move by over one trading session. To do that, we can simply divide by 16. This division by 16 is essentially a shorthand for the square root of 252 trading days. Since volatility scales with time, not linearly, we divide by the square root of 252, which is about 15.87. So, for a back of napkin calculation, we just go with 16. Okay, after doing this, we see that the market expects a 1-day move of about 6%. Now, remember, our view is what will happen a week from now, not in 1 day. So we have to take that number and multiply it by the square root of the number of trading days our view is based on. So, it'll be 6 times the square root of 5, since there are 5 trading days in 1 week. This gives us a 1-week expected move of about 14%. So, right off the bat, we are already told by the market that our 5% estimate is too small. If we were to buy call options 5% out of the money, and in 1 week the stock moved up exactly 5%, we would lose money, despite being correct on both the time and the direction, as what we'd pay in extrinsic value wouldn't be enough to cover the intrinsic value at expiration. When evaluating any options trade, this should be the first step in determining which one to buy or sell. Unfortunately, this calculation is rarely done among smaller traders. Okay, great. So we know what the market expects now, a 14% up or down move in a week. But how do we actually make money from this? At this point, we can either go off the deep end and try guessing whether that number is right or not, or we can structure a trade around that right away. You see, the market isn't one godlike person. It's a cumulative pool of thousands of participants, all with varying incentives, ambitions, and use cases. That means over a long enough sample size, implied probabilities tend to be pretty accurate. However, by the nature of expected value, if we have a 90% win rate, but we paid odds that already baked in those odds, we'd end up completely flat. So, as we'll cover later in the video, we'll try to find a good middle ground between just selling options blanketly around that figure and waiting for odds that never come. Now, we're not going to turn this into a programming tutorial, but to get started, you're going to want to know a bit of Python. Sure, there are other languages, but it's become a lingua franca of sorts, and unless you're doing ultra high frequency stuff, it is often all you need. To begin, we'll start with another very important step that many small traders skip: backtesting. You may have an idea of a sample trading strategy, say doing X every time Y happens. but you need a way of answering the question of, if I made that same decision 100 times in a row, would I end up with more than I started with? That can only be found by getting your hands a bit dirty and going into the data yourself. Again, we don't want to turn this into a programming video, so instead of going line by line, we're just going to take a look at the key sections so that you understand what's going on. First, we assign our core requisites. This is just for mapping our API keys that we'll use to pull data. In this video, we'll pull data from Massive, formerly Polygon.io, and options data from AlphaNum. Next, we can see the exact calculations we're making each day. For each trading day, we first retrieve the optimal strikes from the AlphaNum dataset we sourced earlier. This contains an upper and lower bound of where SPX is likely to stay within by expiration on that date. After we have our strike prices, we then isolate the puts that are below that lower strike of which we want to sell. Because our starting view is that by the close of trading the index will be above this lower strike, we expect those put options to be worth 0 by expiration, so we seek to sell them. Now, this next step is very important. To retrieve the price of the option at that point in time, we specifically fetch quotes. These are the actual bid-ask prices that were present at the time of trading. Many beginner quants make the mistake of using open high low close or OHLC prices for option backtests. With OHLC data, records are only saved if a trade happened in that window, and further, OHLC data tends to be aggregated. For instance, if you're looking at hourly data for January 1st at 10 a.m., you will actually be looking at the final traded price at about 10:59.59. This is suboptimal to quotes, where you can narrow down by the second and see not just a historical lens of what someone executed at, but what you could have plausibly executed at, since you have a record of what was being offered on both sides and at what prices. Because SPX is extremely liquid, we use the mid price at that timestamp for simplicity. In single stock options, this method is risky as the spreads can be incredibly wide, but more often than not, mid-price is a good enough approximation for deeply liquid instruments. We then do the same thing for the call side. Once we have the prices of the options, we combine them into an iron condor structure. This essentially gives us a profit if SPX stays within our strike prices by the close. After we have the price we plausibly could have traded at, we store other auxiliary information like the max loss on the position and the premium collected. Finally, we pull the actual closing value of SPX that day and calculate the profit or loss generated at expiration. Because an option spread is generally defined risk, we do not lose more than our maximum loss, and our P&L is cleanly tied to the intrinsic value remaining depending on where the index actually closed. Once this trade record is saved, our loop then repeats this for every trading day in our sample. 0 DTE options are relatively new, so for this, we went back as far as we could up to the present day. After this loop completes, we combine all the results and create a plot of what the general performance would have looked like. As demonstrated, while it was far from a money printing straight line up, it held up pretty well, with about an 88% win rate and an average implied probability of about 80%, allowing us to have an unlevered expected value of about 8% for each unit of risk. We don't want to make the mistake of overfitting by filtering out dates, adding machine learning models, and the like, so next, we're going to spin up a live production version that will allow us to see the outputs as they come in real time. For our production script, we want to keep the core logic the same, with the only difference being that we only want data for the latest trading day or today. So first, we pull the most recent trading date as of the time of running, then pull the relevant strike data from AlphaNum. This dataset is typically published at about 10:30, an hour after open, so if we're checking too early, we'll get back a message letting us know that it isn't ready. After we have the strikes, we simply save it to the defined variables and create a simple output letting us know. As demonstrated, on March 31st, 2026, our data indicated that we were in a high-risk regime and that the likely strike band for the index would be between 6370 and 6510. On that date, the index went up significantly, returning 3% and closing at 6528. Because this is above our estimated cap of 6510, selling options outside of that range would have resulted in a loss. This demonstrates that even with a stable quantitative framework around the trades, there still isn't a crystal ball that will always be accurate. On average, you expect to be right more than you're wrong, but that doesn't mean you'll never be wrong. A key benefit of this dataset is that the values are never retroactively altered, so the data you see at trading will always be the same data you see when doing backtests. So, now that we've backtested our idea, set up a system to get the optimal trades in real time, we'll end things off by automating the pipeline so that we don't have to manually execute each time. To automate this, you can use any broker that has a public API with documentation you can understand. For this example, we'll be going with tastytrade as the API is easy to understand and we have reliably executed through it for years. Before diving in, we should briefly note what the main advantage of automation in this case is. The main benefit of automation here is to allow enough trades for expected value to actually play out. In many cases, a trader might go through this process and launch the strategy manually, but when they inevitably hit a streak of negative variance, they decide to wait and pause the system. Almost invariably, the strategy returns its expected performance as nothing fundamentally has changed, but the trader keeps it off in fear of catching more variance. A backtest of multiple years takes an hour to run, but getting a year of forward trades takes a year, and that gap can take some getting used to. By automating the strategy, it just runs continuously, through good variance and through bad variance. Assuming you're taking low notional risk relative to the size of your account, this staying in the game approach is how you collect a statistically significant amount of samples that allow you to realize the expected returns of a strategy. So, coming back to the code, after we have the optimal strikes of the day, we first verify our connection to the broker API by logging in and checking to see if we can retrieve our buying power. If we're able to successfully retrieve our account details, we know that we properly connected to the API. Once we have the strikes, we pull the broker's options chain and map them to the symbol formatting they accept. This just turns the strike prices into the actual contract symbols accepted. After we have all the symbols we need, we then get the latest price quotes for each option and construct our spread. Before pricing the spread for submission to the exchange, we can choose from 3 options: the natural price, the mid price, and the optimal price. The natural price is the price you can get immediately filled at, assuming you cross the entire bid-ask spread all 4 ways. We'll address option execution in a future video, but while this will get you filled the fastest, it is a horribly suboptimal choice, as losing $5 on each leg can destroy your EV over time. The mid price is our second best bet, as it represents a generally fair price. The drawback is that it may sit on the order book for a while before it gets filled. If there isn't a significant price move, this may end up executing fine, but it has the risk of sitting on the order book indefinitely, resulting in no trade for the day. The optimal price is a good middle ground, where we just take the mid price of the full spread, then deduct it by $5. From our own experience, this tends to fill pretty fast and doesn't shave off much edge, if any. Finally, we submit the order to the exchange and get back a status, letting us know if the order was sent successfully and that it was indeed the intended order. The last part of this system is the automation that will allow this file to run at the exact same time every day. And this is actually the easiest part. To do this, we'll simply grab the cheapest $5 plan from Python Anywhere and install the necessary files and packages. Once set up, we then create a task that will be scheduled to run every day at 10:30 a.m. At this point, you now have a fully functioning pipeline. To recap what we actually built, we started by addressing the single most common mistake retail options traders make, which is ignoring what the market is already telling you through implied volatility. We then showed you how to convert that into a concrete expected move. From there, we moved into backtesting with real quote level data, not the aggregated OHLC bars that most people rely on and that quietly destroys the accuracy of any option simulation. We ran that backtest across the full history of 0DTE options on SPX, got a realistic picture of what the strategy actually produces, and then rebuilt the same logic for live execution. And finally, we wired the whole thing into a broker API and scheduled it to run autonomously every single day, because the entire point of having an edge is letting it compound over enough samples for expected value to actually show up. From backtesting to real-time outputs and finally automated execution, all running on a $5 server. The full code for everything we walk through today is available in the Alphaneum Strategy Lab on GitHub. Feel free to pull it down, verify on your own, and modify it however you see fit. Alphaneum is a vendor of proprietary datasets built by quantitative traders, and the goal behind every dataset we publish is straightforward: to help traders make money. Not a dashboard, not a sentiment score, not a visualization you stare at and then guess, but structured, reliable outputs that you can plug directly into a trading system. Thanks for watching, and we hope to see you in the next one.